Woohoo! And I will check out who is coming in. Tom, welcome. Nicole, how you doing? Charles, welcome. Brian, Angela.
Hi, Angela.
I know Angela's in North Carolina.
Mhm.
Elaine. Let me check this out. Ooh, it's coming in so fast. I can't say the name.
Fucking.
Frank, Jackie, John, Junior, Kimberly.
When she retires, she's going to be a Walmart greeter for sure.
Still gonna have a job. Employable. Richard, Sherry, Tom. Woohoo! Welcome, everyone. Welcome, welcome. So what are we going to be talking about today?
Hold on. You want me to get started now?
Are we going to be talking
You seem to be having so much fun welcoming folks.
how great the temperature is in Puerto Rico?
Shh, be quiet.
It's about 89. Okay.
Okay,
I'll
guys.
stop.
Welcome to Compliance Conversations, hosted by Insurance Licensing Services of America and the clowns here at Spot On Insurance Podcast. Today's topic is mergers and acquisitions in the insurance industry, challenges and best practices.
Thank you, everyone, for coming and joining us today. This is going to be a 2-hour session. And believe me, it is going to be jam-packed. Today, we're going to be streaming on LinkedIn, Facebook, Twitter, Periscope. If you have questions, write them in the Q&A section. If you want to say hello, you can just put that in the chat.
Man, does anybody use Periscope? I have yet to use that.
Our marketing people tell us that that's where we're at.
Christian, we're at Periscope.
Right now, we got to give shout out to Periscope. We're live on Periscope. So,
all right, give them some play. Well, as she said, this webinar is a mini series of 3. And joining us today is Andrew Burnett, CEO and managing director, the Acela Group. Take a bow.
Give a little wave, guys, so that people know who you are.
Michael Mensch, CBI managing partner
at Agency Brokerage.
Dave Ravel, partner, head of sales, marketing, and M&A at Element Risk. And we've also got Brett Smith, InsurTech New York founder.
And he should be joining us.
Mike Strakoff is SVP, head of insurance lending, Live Oak Bank. And we've got Stephen Weiss, partner at Levenfeld Pearlstein, LLC. And Corey Witter, Vice President, Private Equity Mergers and Acquisitions Group, Marsh. Welcome, everyone.
And then I just saw that Brenda joined us, Brenda Sally. She's a CBI at Agency Brokerage. And I saw her for a moment. Now she's gone. But maybe she'll pop back in.
Reappear.
Yeah. And then from our ILSA and Spot On Insurance team, we have Russ Foster, who is our general manager. We have Joyce King, who will be fielding questions and keeping it all going. And she will be our chat manager. Christian Masonette, he is our manager and making sure that we are good with audio and all the technical stuff. So Joyce, oh my gosh, we are going to be covering M&A in the insurance industry. We're going to be talking about deal structures, positioning companies for sale, partnering with advisors, and so much more. I want to also let everyone know that if you're in the future can't join a webinar, you can check us out on YouTube on our Spot On Insurance channel. We'll show that to you later on. But Joyce, take it away. Let's get it started.
Okay, well, to start with, let me say real quick, if you've got a question for our panelists today, please come into the Q&A to submit those questions, because I can see those right away. If you're submitting questions in the chat, it moves very quickly. I may not see it, but Arlene usually helps me out on that where I drop the ball. So, but try to use the Q&A if possible. The chat is simply for chat, and we do get a lot of extra good info in there. Lisa McClochick is great to put stuff in there, so you can be watching there as well. So today we thought, under normal circumstances, we would just be able to come on here today and give great advisement about the M&A process, and you are still going to get this great advisement that we promised you. But before we can go into the normal, everyday, run-of-the-mill M&A stuff, is there any that's really normal, run-of-the-mill? Probably not. But before we can get to that, we've got to address the current environment. And so what is so significant about the current environment? Well, this is 2020. So 2020 is full of all sorts of surprises, right?
Sounds like such a mild year. 2020, it sounds so soft, right?
It sounds that way, and it's been anything but. So we want to first tackle some harder topics like how the COVID pandemic has affected mergers and acquisitions. And then, of course, this is also an election year. So I know that there are that affects things as well. So
I'm going to just step in for a minute, because on COVID, one of the things that we have, just an article that came out today in Business Insurance by Judy Greenwald, she talked about that the M&A activity is just like really getting really fast tracked, because so many, especially in the insurtech space, because a lot of traditional companies are feeling like we really have got to make that digital leap. If we haven't invested in it, we've got to get out there. So that was a really good article that just came out today. And of course, we're already starting to see that trend, that there's a lot of M&A activity picking up. So it's healthy. There was a little pause there for a minute, but we're back on track.
Seems to be. Before we get going, well, I'm gonna pose a question to everyone on the panel. And let me go ahead and give you that question. So I want to ask all of our panelists in just a few sentences each to tell us how the pandemic has substantially changed the way that you move through your part of the M&A process. And before I pick on anybody to start, I'm going to pick on Michael Minch, so you'll go first here in just a minute. But before we do that real quick, Ted and Arlene gave great introductions for everyone, but if the attendees are anything like me, from your title, I don't exactly know where you fit in the process. So I just want to I'm dumbing it down for myself, but I'm hoping to help our attendees out as well. So I gave you guys some simplified titles, and I hope that's okay. M&A advisor. Who's our M&A advisor? Michael Minch, thank you. Our M&A attorney, that'll be Stephen. Thank you, Stephen. We've got a buyer in the room. Who's our buyer? All right, Dave. We have a lender. Mike Strackoff, thank you. And then we have an advisor and investor. That is Andrew. Thank you, Andrew. All right, I hope everybody's got your Big Chief tablet and your number 2 pencil, and you're writing this down, because you're going to need to know this for the next 2 hours and for the future sessions. So our M&A transaction risk advisor, that's going to be Corey. Thank you very much, Corey. And we hope to have Brett join us today, and he is in the insurtech space. All right. Okay, so back to our question, and that is just in a few sentences, just give us kind of the general overview, because we've got more questions to come where we'll dive a little bit deeper into this, but just let us know a little bit about how the pandemic has substantially changed your part of the M&A process. And Michael Minch, if you don't mind, please go first.
Sure. So the first 3 months were probably the most interruption. The biggest challenge was scheduling meetings between buyers and sellers. So, and the challenge we had was number of buyers were based in areas where they had a lot of outbreak, like in New York, New Jersey. So I think things are finally getting back to normal. We're scheduling meetings. In the beginning too, there was a lot of questions about what impact the pandemic would have on agency revenues and valuations. But I mean, from my perspective, and I think others on the board here would probably agree, that I think things are getting back to normal. And the answer is really, so far, we're not really seeing an impact on valuations. And there's just a lot of, there was almost a pause for a little while, and now there's a surge of deals that are happening to make up for that lag time. So that's kind of what we've been seeing over the last 6 months.
Thank you. Thank you, Stephen. Can I call on you next?
Sure. I'd definitely echo what Michael said. I represent both buyers and sellers of insurance agencies. I would say early on in the process, we probably in April and May, we had more deals. We were still able to get some deals closed, but we had more deals kind of die on the vine in those couple months than I had probably die in 15 years. A lot of those were books of businesses really tied to hospitality and some industries that were clearly at risk. So that was certainly a change for us. The reality is oftentimes when a deal gets to us, the deal has sort of been baked, whether in an LOI, again, whether we're on the buy side or sell side. So, has there been some challenges? Speed, I think things are taking a little bit longer. It just seems buyers are certainly going to do a little more diligence. They're a little more cautious, but we're kind of full steam ahead. Lately, the biggest issue in our world of M&A has been really PPP related. A lot of deals, a lot of agencies have borrowed PPP funds, and everyone's now in the process of submitting for forgiveness. Mike would love to get some of your take on this later. Sure. Candidly, the SBA has seemingly gone dark on us the last 4 to 6 weeks. We are hearing from a lot of our lender friends that the SBA is supposed to issue some new guidance on what I'll say is the interplay between PPP and M&A. It is really become an issue right now. There are multiple deals at our firm, at firms across the country that are somewhat in a holding pattern. I suspect some of those deals may be more stock deals than asset transactions, but some sellers are pretty conservative and don't want to go ahead with their deals until they get SBA's consent to a change of control, and the SBA's gone dark. So right now, again, I'm taking more than a few sentences and I apologize. Kind of the issues have been very, very fluid over the course of the last several months, but today the topic du jour in my world is definitely PPP.
Glad you mentioned that. We will definitely cover PPP a little bit later. Mike, please.
So I would concur with the prior comments around some of the challenges right out of the gate. Definitely slowed down, but I would tell you now, my day to day, we are busier than we've ever been. A lot of what COVID created was the CARES Act, which PPP was part of it. Another aspect of the CARES Act was, from an SBA perspective, was allowing those that had an existing SBA loan, they were getting 6 months of principal and interest paid by the SBA from the date of basically April 1st through September. And anyone who closed the loan before September 25th, an SBA loan, also qualified for that program. So as you might imagine, very popular. So today's the 24th, the last day to close a loan is tomorrow. Anyone who closes a loan before tomorrow with the SBA gets their next 6 payments made by the SBA. So our lives went from being, relatively quiet to PPP mode, which was crazy, to now trying to meet the September 25th deadline. So we've been extremely busy working on the SBA financing pieces. And just as we look at deals, we want to, through all this, do a deeper dive, understand the book of business more, understand, if it's a commercial agent, what industries that they are, if they have any aggregation or concentration in any particular industry. So we're getting a little further into the weeds with our clients, which takes a little bit more time, but I think it ensures that we all know what we're getting into pre-financing. So,
thank you, Corey.
Great. Well, thank you. I'm hearing a lot of commonality across the board here. Ultimately, what we saw, right after March was a very, very slow M&A field, especially on my end, where I'm focused on insurance due diligence for private equity firms. So, of course, the lenders aren't financing and there's scrutiny at that level. Our engagement slowed down. However, there's been a huge upswing, I would say, as of late July. So it's, I think professionally it's going back to a sense of normalcy, but of course, personally, I'm at home, as you can see, so that still will remain the same. But, at the onset of the pandemic, from an insurance standpoint, transactional risk insurance has been, a very, very tremendous tool for private equity firms. And carriers have been scrutinizing that since the onset of the pandemic. However, we've seen them sort of become a little bit more lax in terms of the questions they're asking related to COVID fluctuations of exposures and in different areas. But generally speaking, I have to say that there's been a great deal of improvements in the M&A market and the activity over the last 3 months, which is very favorable for us on sort of the the advisory end.
Thank you, Corey. Dave, please.
I would say for us, the when COVID first hit, for a lot of sellers, they're kind of passing the torch of their business. So for us, when COVID first hit, part of what they're thinking about is retirement and all that kind of stuff. And so I think that there was a general sense of fear out there. The stock market was crashing, all these things. And so we had a few people completely pull back and say, we're not going to sell, because I think at the end of the day, just there was this fear that a lot of people were feeling. And so they were saying, well, if I get all this money and go and put it in the stock market, where's it going to go there? And at least this I have some sense of control over. But that, I would agree with what everyone else has said. That seems to have faded. In fact, one gentleman who had kind of said, not doing it this year, called a couple of weeks ago and said, could we do it by the end of the year? And that kind of gets to the second topic that is definitely on our radar. We are in an election year. And so a lot of the people we're talking to are also concerned about what might happen from the tax side of this. If there is a change of power, from the government. So, as it relates to long-term capital gains and all these different things. So that seems to be very much on people's radar. So now there seems to be a little bit of rush for those people who were on the fence. Hey, could we get it done by the end of the year? So we pull some of that, what I'll call like governmental risk off the table, tax basis risk. So we're seeing a little bit of that as well.
Awesome. Thank you. And Andrew, round us out.
Sure. I also echo some of the same issues that most of the panelists have already mentioned. Definitely as an advisor, we've definitely seen that the time to get through deals has lengthened. I think on the positive side, we've seen that we were able, especially as I'm representing clients that are buying, that we were able, because of the uncertainty, we were able to negotiate better pricing, and which was tremendous. I also deal with a lot of industries outside of insurance, and so I was actually, as an investor, I was working on 2 deals in Jamaica, a hotel and a business that did 90% of their business with the cruise ship industry. And of course, like that, we were on the contract, we were getting the legal work done to go to closing, and everything disappeared. So those industries, we're looking at, definitely they're not generating revenue. However, I think there's some great opportunities to create some great structures to negotiate the sale under these environments. And so, we look at it as an opportunity in terms of us buying, and also there's some opportunities on advising clients to buy also.
Awesome.
Joyce, can I add something based on what Andrew just said?
Absolutely.
For a little extra context on that, we had a good friend of mine who specializes in restaurants on the East Coast, particularly, shore points and that kind of thing. He was actually under contract to sell at a very high multiple, but because of COVID, what the industry, what he's getting, and this is one circumstance, but the industry used to really tout his focus, his niche focus. And now he's getting penalized for it big time. And so we're seeing some people start to say, hey, can we look at secondary and tertiary markets, like smaller outside of major cities, and maybe more personal lines than we used to want, and that kind of thing. So the diversity, where it seems like the industry used to reward focus, there's now some reward going to diversity that's affecting book values. So that was kind of one circumstance, but he's in a bad spot compared to where he was going to be prior to this.
Right.
Hey, Dave, timing is everything.
Yes, that's right. Absolutely.
Thank you all for going around and answering kind of our kickstart question. And Arlene and I will be pummeling you with questions for the rest of the 2 hours. But before we can get started, we already have 2 questions that have come in through the Q&A live. And Michael Minch has already raised his hand and said he's willing to answer the first one. So I'm going to read that one and let Michael answer. Real quick, panelists, if you can go, if you'll wiggle your mouse, go to the bottom and see that where it has the Q&A bubble, it's got 2. Please read the second question and start to prepare for that. I don't want to read it. It's too lengthy and we will definitely lose something in my translation. But on the first question, do you feel that the COVID situation has perhaps driven agencies to consider a sale? And Michael, if you'll take that, please.
Yes. And by the way, I accidentally clicked that, but I'll answer it. No problem.
You got it.
I think so we are busier than we probably have ever been, and it all kind of kicked into gear maybe the second or third month into this. So I think the answer is yes. Was it a relation to their fear of how it impacted their business? Probably not as much, as everybody knows that the market multiples have been really high in the last couple of years. And so I think that the concern was this was going to be the tipping point that would, reset the market values. So the answer is yes, maybe not necessarily because of the disruption to that person's business, as much of a concern about the impact it would have on the capital markets and this market for selling an agency.
All right.
Joyce, I would add to that. Probably more anecdotal than anything. Aside from COVID, there's just a lot of stuff going on in the world. Okay, social issues. We all know what's going on, and we've, again, just somewhat anecdotally, I think we've talked to some maybe agency owners and owners of other businesses who are, let's say in their 60s or something, or baby boomers, and a lot of them, I'm not saying they're just ready, willing, and able to turn over their keys, hand someone their keys, but there is sort of this sense that it's hard to operate a business. It's hard to, it's hard to operate during COVID, but it's hard with everything that's going on in the world. Every move is scrutinized that people make, and it's a tough environment to operate in. And certainly in the agency world, we've talked to some agency owners who say, you know what, let me sell to to Dave or some of the other buyers that are out there. Let them deal with the people issues. I just want to produce insurance. I don't want to deal with the HR issues, all this other stuff, because there's a lot of landmines out there, and people kind of, they just don't want to deal with it. And again, to Michael's point, multiples are really good right now, and you sort of see those things coming together. I would say there's also perhaps a fear that if multiples do go down, again, some of these people may not want to ride it out another cycle and press their luck. Maybe they can get an extra turn or something, but you know what? Times are tough. It's just a tough environment to operate. Let someone else take their turn.
Yeah. I don't mean to jump in again, but so I remember I had a conversation in February on another discussion like this, and the topic came up was when is the next recession coming? Because everybody knows the market cycles, right? And this was in February timeframe. The response was, "Oh no, don't talk about that. That's not going to happen." A month later, who would have guessed that this pandemic would sweep across the world and change everything? But the economy cycles, the valuation cycle. So as Stephen said, if we reach a point where the market resets, then how long will it be before it cycles back again? And so I think everybody understands that. I think that is driving some activity this year between COVID, between presidential election. There's a lot of things going on that creates potential uncertainty for what lies ahead.
You also, and sorry for keep jumping in, you also, I think, are getting a lot of owners who they're looking at their team. Okay, who's on their staff? Are these people, am I going to be able to perpetuate the business by selling to this pool of employees? So you're seeing a lot of sort of, analyzing of how am I going to exit? And am I really confident that this group of employees, one, are going to stick around, but two, if they're going to stick around, are they going to take me out? And am I going to sell to them on a hope note, or am I going to go to one of the buyers out there that's paying, huge multiples? So I think, all this stuff kind of converges. And it's definitely led to, it's crazy. It seems that activity, and it's echoed across the board here. We've been as busy as we've ever been, and you just never thought that would happen in this environment. But it's fourth quarter should be wild.
Yeah, I think we've had a number of conversations. I think it's kind of knocked some people off the fence. So those that were kind of knowing they're getting to the point should be considering it. It's time to perpetuate the agency. And something like this has probably allowed them to focus on what happens, if I did get COVID, if the taxes change, if the markets change, multiples change. I mean, there's a lot of variables. And I think people see this as probably as stable as it's going to be. And the futures definitely has some instability potentially. So had a conversation the other day with a relatively small agent, but he's like, look, if I pass away, I have no perpetuation plan. The value of my agency likely to get impacted, would have to probably sell it at a discount. I really need to put something in place now, and is trying to put the pieces together to make that happen. He's like, I wasn't thinking about this 5-6 months ago. So I think you are seeing some of that.
I'm gonna use two words here: buyer's market, seller's market. Which is it?
Seller's market, and it will be.
Wow.
Seller's
So,
market.
so I want to pose this question to Dave and to Michael. From the buyer's perspective, what are the attributes that you're looking for, or that a buyer is looking for in an agency, that the ideal agency that they would look for to purchase right now?
Dave, go first.
All right, I'll go first. I would say the attributes that we would be looking for are, one, a strong team in place, probably more than anything. So, but I think that goes to who the buyer is. So I do think you have to start there, and that's something that an agency who's thinking about selling, you really do want to think about who your buyer is. Is it strategic? Is it someone who's local? The one thing I'm always surprised at is that agency owners don't seem to, there's been a history of competition with the agency 6 miles down the road, 7 miles to the east, whatever. And sometimes those could be amazing marriages. Think about that team that doesn't have to relocate. There could be some, you pay one rent instead of two. There could be, and you're still serving that community. So that's always something, certain agencies are more comfortable having their peers and counterparts as close friends, but that can be a great thing. But so team and the people is number one, but that's also because we want to stay in the communities that we buy in. So we are looking at that team. Are they members of local civic associations? Are they just active online? And is there any presence? Is there any digital footprint to that agency within their space? That would be a second thing. What does it look like as a third party looking in, a neutral third party looking in? Does that agency look like they're kind of dead already and they just don't know it? Or do they have a vibrant online persona? And it could be, I've literally seen agencies that have 2 people in them and are just doing incredible things online. So the optics are that this is an alive and well organization, and that adds value for us as buyers, if you're looking to stay in that community and that kind of thing. So I would say for us, those are the main 2 things. First, the team, but we've always found that our selling agencies, whoever the owner is, typically something about them reflects their team. But that's a hard thing as a buyer. You don't always get to meet that team. So sometimes one of the most important things is kind of a question mark, and you do have to rely on who that owner is, and it will reflect the team. So people and who they are in their community. So it gets to, both of them get to culture. That's big for us.
Yeah, I'd say, the saying is the buyer pays for the past, but is buying the future. So it's, the people are a big part of that because that's what's going to continue to perpetuate the business. Growth history is a big factor that a lot of buyers look for, and not every agency is growing, but carriers, all the typical things, but it's the buyer is paying for what you've already done, but when they go into due diligence, they're going to look at everything to make sure that that's business going to continue perpetuating forward on the similar revenue stream and everything. So, that's where you look into the risk of the book of business with carriers and the concentration with clients and things like that. So, they're buying what you have and evaluating it based on how that's going to look going forward.
If I could add maybe one thing that I think would be, important, and it's one thing we like to see with those that approach us on the financing side, is really, if you look at the buyer and seller and any overlap in carriers at times can be an immediate uplift to the buyer. So from either contingent commission perspective or volume requirements and things of that nature can be very attractive to a buyer that, on its face, it's X amount in revenue, but combined, it could be just have an effect on revenue, which certainly can be a positive from that perspective.
That's a really good point. Thank you, Mike, for that. The carrier overlap, very good.
I want to throw out there too, one thing that we missed is profitability. I think that the industry has a expectation of X amount of times revenue. And we've talked to agencies, big agencies, that there's small agencies that are very profitable and there's large agencies that are not. And that matters. It's not so much, we said it's a seller's market, but there's still nuts and bolts and black and white numbers that it comes down to. So when you run a profitable business that has those other things that were mentioned here, that's how you're going to maximize what someone's willing to pay for. And I think that profitability sometimes goes to just running your business like a business. We see all the times cousins that don't really work in the business are on payroll and this and that, and where it's kind of lost its business side or professional. I don't want to say it's not professional, but it's not necessarily run as tightly as it might be if it weren't family owned or something along those lines. And those things matters when it's time to exit. They really do.
Because you've got to get someone like Mike to finance a transaction, and they're going to look at the cash flow to determine what they can lend on the business.
Mm-hmm. Absolutely.
Joyce, if not said already, I would add geographic footprint for some of the buyers out there who are looking to grow in some strategic areas. We've done deals in some crazy parts of the country, and but geographic footprint is really important. I would also, again, if maybe it was already suggested, but some sort of industry specialization, really adding to a deeper bench is something that's looked for often in these deals.
I have a follow-up question on that. Has a geographic footprint, has that changed somewhat as a result of COVID and everybody going online, and all these companies that weren't being as profitable online are now finding different ways so that it's kind of flattened the world a little bit? What are your thoughts on that?
I would say that for us, when we would make an acquisition, what we used to do is literally, kind of drop a pin on a map and say, who are those other agencies who are kind of in a 15, 20, 30-minute radius, and then start to look at, carrier alignment and things like that. And now I would say that has changed because of the technology that's available. What we're doing right now is a perfect example. We do this internally as a team where we have offices in Virginia, Western Pennsylvania, 5-hour drives from each other. And I think they used to feel more apart. We've actually seen, I always, what has come out of this is that I think this medium is difficult for making relationship, but I think it's fantastic for maintaining relationship. And so because we have other things that we had a relationship already, it's actually brought our team closer together despite physically being far apart. And so that has kind of changed our view on the industry a little bit and what opportunities, what we can actually do now that some of these things are available to us.
Yeah, I think it's depending on what geographic spread means, is it the agency one county over or 8 states over? And there's still people involved. We look at it through the lens of you still have to manage people. And, you might be acquiring an agency that you now need to manage virtually. You don't know you don't know your new virtual employees or your new virtual partners. That can be a challenge with not necessarily being in an in-person environment at any point. So we do still see some challenges, but if there's an effective team in place that are currently managing, that remote team that's being acquired, we can get comfortable with that. But a lot of folks are in a virtual environment for the first time and still working out the kinks and trying to figure it out. So it's kind of case by case, but I think there's a yes there and a potential no, depending on the situation.
Yeah, and I just wanted to say one thing is that also what we've seen is, especially in this environment, having that seller also being involved in the transition, that helps to ensure that there's continuity, and especially in this environment, I think that helps also.
Andrew, I think that's a non-starter in many respects. If a seller doesn't want to go along with the deal, Dave, I think you were talking about it on the other day when we were huddling, but we just had a deal that died because, somewhat strange, 30% of the deal was in an earnout, which I'm sure we're going to get into later, Joyce. But just given the structure of the deal, you think the seller would absolutely expect to work for several years post closing, and this seller was take the keys and I'm moving to Hawaii.
Wow.
Very much a strange thought process. Candidly, something that we usually don't see, and certainly, maybe the biggest red flag for buyers if a seller does not want to continue on in the business and really grow it.
Great point. All right. Dave, if you could, there is a question specifically for you in the chat. And if you want to type that back, or we can go over that live, but they're asking some specific information from you. But I'll go on to another question real quick while Dave's looking at that. And this is for Mike. What has your involvement been as an SBA lender related to all of the stimulus money from the payroll protection program and the payment deferments?
So our involvement was very heavily involved in both areas. So PPP wise, I think we did over 10,000 PPP loans. So heavily involved in that. We did a number of them for existing customers, but even more for non-existing customers, both inside insurance. We specialize in a number of industries, including insurance. So we were very involved in the origination of PPP loans right out of the gate through the second round. So what that means is now we're in the beginning process of getting involved in the part 2 of PPP, which is forgiveness, and allowing customers now to apply for forgiveness. And that is early stages. There are some ongoing expectations that things may change, but we're working under the current environment, current rules. And at this point, the forms are what they are, the requirements are what they are that they need to supply. But we haven't really, have a situation where we've received official feedback on any particular application, as far as I'm aware. So more to be seen in the future. So that is actually something interesting to watch, as we get into the election year and additional potential stimulus packages. Whether that includes changes to the rules or not, we'll find out. With regard to the subsidy, I made some comments earlier with regard to that. So that references the any existing customer had the 6 months worth of payments made, assuming that they were in good standing by the SBA. If you were an existing customer, and for any new customer, if you closed the loan and funded before close of business tomorrow, you'd also be eligible for the same program. So we're very involved in that. We don't know what those numbers are going to look like until after tomorrow. But I would tell you the last probably month and a half is probably the busiest we've been as a bank for a quarter, and very busy as it relates to insurance deals. So 2 great programs, certainly getting dollars in the hands of small business. But they've been wildly successful from what we can tell so far, at least from the origination perspective. PPP still needs to be seen on how well forgiveness goes.
Wow. So Mike, so like you said, you guys have been so busy. So even more so that we really appreciate your participation in this session today and the following one. So thank you.
Thanks
Now,
for the special recognition.
so we've been chatting like for nearly 30 minutes or so, a little bit over 30 minutes, but I would like to just take a pause. And Andrew, I'm going to direct this question to you. I want you to just give us an overview of deal structures. Talk to us about the difference of a merger and a sale or purchase.
Okay. So a merger basically is you're combining forces with another business. And so it's a partnership. And the dynamics of that is a lot different than it would be for a sale. And so in a merger, you're looking at synergies for the two partners coming together, their ability to work together. There's complementary skills and abilities. Shared vision, I think, is important when you're looking at a merger. And just from an experience that I just had, because we buy companies also. I bought a company last year. It's probably one of my learning lessons. And we bought the company because we got a good price, but we were only buying 50% of the business. And once we acquired it, the remaining partner, we just didn't get along. And that definitely, whatever opportunity that we were looking to exploit, just because we did not get along as partners, that really helped to, not make the relationship work. And so it's important that when you're looking at merging, that there's a shared vision of how the company is run after the process goes through, and that the clear roles and responsibilities are put in place, and that you genuinely like each other also. I think that's something that you have to look at. Merger also involves corporate culture. What if you're having two organizations come together, what type of culture is there? And can those two come together also? And so it's a lot different than if you're looking at a complete sale. At a complete sale, you're looking to take control of the entity. You're looking at some period of transition going forward. And as we mentioned before, having the seller also involved, maybe anywhere from 3 to 5 years going forward with the entity. Yeah.
So that's really good. One of the things also for all of you agency owners that are here as attendees, the implications in terms of licensing and your filings with the Secretary of State are so vastly different when there's a merger or where there's a sale. So we've covered those things on a previous podcast, but we're going to be doing a fresh one on Spot On Insurance. Joyce is going to be on it, as well as some of our clients that have gone through some deals, and we're going to be talking about the licensing implications and things to look out for. So that's going to be coming out sometime, I believe, in the next 6 weeks or so. We'll be having that episode. So it's a good thing to know.
Arlene, it's worth noting, and Michael, you can confirm because you probably see more deals than any of us. In this industry, I would say conservatively, 98% of deals are structured as asset sales. Michael, I don't know if you would agree with that statement.
Yeah.
You almost never see a merger, a legal merger. Occasionally we'll see stock transactions, but that's generally driven by a legacy seller who's structured perhaps as a C Corp. Most of the big buyers in the space really do not want to do stock deals. They try everything in their power to not do a stock deal. In lieu of a stock deal, sometimes in certain circumstances, we'll see transactions structured as sales of personal goodwill, which is probably a whole 2-hour session all on its own. But again, just for the benefit of potential agency sellers who are listening in, if they're thinking about selling their agency to most of the buyers out there, they're really talking about a sale of assets.
Right. And I would add the reason is because you get a stepped up tax basis when you do an asset sale or an asset purchase, meaning you can write off the purchase price over a number of years. If you do a stock purchase, you're generally assuming their balance sheet the way it is. So that's one of the biggest reasons why buyers want to do an asset purchase.
Yeah, and also you want to do an asset purchase to minimize any legal liabilities also. So that's why you'd want to go that way.
Very good. Michael, Michael Mensch, this question is for you. So, once you're an insurance agency owner for many years, your world becomes smaller and smaller. You have a good networking pool to pick from. You know the buyers, you know the players, right? What do you say to those agency owners that say, I think I could put myself out there on the market? I know that there's a lot to M&A transactions, but maybe I could just, over cocktails, just strike up a deal. What are the things that they should know and be aware of?
You're just about never going to get market value when you do it that way. I mean, yeah, we have this conversation all the time because a lot of the buyers, they acquire an agency. Along with that comes the principal, and then they turn the principal into a deal person for them, where they go out and call on all their friends and then try to bring them in. And so we just had a conversation the other day with one that he got an offer. A friend of his sold to this group. He got an offer. We looked at it, and it was probably 20%, maybe more than that. Actually, the multiple was 20%. The terms were way off of market, and that's pretty common. So the short answer is that competition is what you need when you're going to sell, because you're never going to really get the full market value unless you go out and put it out to a bunch of strategic buyers. They know there's competition on it, so they're going to come forward with their best foot. We see it all the time. We do valuations outside of just, we'll do about 150 to 160 valuations this year. And more than half of that is for lending transactions for buyers that are acquiring. So we have all this data on these transactions that are happening. Our multiples, we have the data to support it. Our multiples are more than a third higher than all the other deals. So all the other deals that we're evaluating, usually buyer, seller, negotiated price. Our deals, we go to market, we're negotiating with a bunch of buyers and getting the highest price. So we actually have data that shows that when we represent a client, we're getting them about a 33% to 34% premium on price. And it's just, that's what happens when you go out and solicit multiple bids. So, you're the owner, you get one shot to do that transaction. So why wouldn't you want to do it in a way that is going to get you the most value from it?
That's so important to know, because a lot of them just have relationships, right? And so they kind of fall into this role of, well, that's a buddy of mine, or, it's a nice company. And really, they've invested so much time and effort in building this company. They want to be able to get the most for their.
Yeah. And you don't know anybody's risk tolerance, right? That's really the big thing. What is the cost of their capital for buying a business, and what's the risk tolerance? Because the local agency may be the smartest one to acquire you, make the most sense. But if that individual doesn't want to go borrow money, or that individual, has different personal credit issues, they may not be able to come up with the highest purchase price. So, and the other thing that people don't realize is the reason why these private equity groups are able to pay a higher purchase price is because all their debt is interest only. So they just borrow money and they're constantly rolling it forward. Whereas the average person, when they go to buy an agency, they got to pay back principal and interest. So that's where you get the multiples being much higher from a private equity buyer. A big part of that is because their debt structure is much their cost of capital is a lot lower than somebody that's borrowing the debt. So that's probably a confusing answer, but there is a lot of nuances to different types of buyers in the marketplace, and one of them is risk tolerance and their cost of capital. That was confusing, wasn't it?
No, that's good. Very good.
I could tell you a joke to cut the tension. I don't know if you saw that my lights went off a little while ago. I have a motion sensor on my lights. So if I sit still for too long, it's going to get dark in here.
So I see some of the feedback that we got on our Q&A is, next time we need to post the speaker bios and agenda. So that's helpful.
Now we'll be able to post some of that information in the YouTube. So when they go in there.
Yeah.
Because this goes tomorrow, we'll have it processed and it'll be live on YouTube. Anybody can go and see it at any time. So we can't post further information in there, but just so that you guys know, there's already people wanting to know your bios and
yeah.
interested in your services.
So Joyce, do you want to take the question from Q&A from Sari? Or
Yes, we'll put this out. I'm interested in buying an insurance agency that mostly deals with life insurance and financial planning. Are these agencies common to sell? Also, how do you value these businesses?
And by the way, hi, Sari. He was he's one of our past guests on our podcast.
Okay. Anybody wants this one?
The question is valuing a financial services practice.
Are the life insurance and financial planning agencies common? Do you see those commonly for sale? And then how do you value?
So I can answer part of it. Michael, you can probably better speak to the valuation, but definitely some of the buyers in the space are definitely buying wealth management firms that, these firms. It's probably in the last 3-4 years, I've personally seen it. It's become more prevalent. A lot of insurance agencies will have sort of a wealth management arm to them. So perhaps that's been part of the driver here, but definitely a growth area. Little bit different in terms of the regulatory scheme, and there's different issues, but I don't think all of the big buyers, Michael, you would know best, but definitely some of the big names out there are definitely in the space.
Yeah, on the valuation side, I mean, if you're talking about a life insurance brokerage, that's complicated because unlike P&C insurance, life insurance is almost all front loaded on commissions. So then the big question is how much of the revenue stream is based on renewal commissions? And the average life brokerage doesn't really have a good handle on that answer. But the financial services side, I mean, that's a very active M&A marketplace. We specialize just in insurance industry, but there are other M&A firms out there. And Mike Strakoff, I think Live Oak works with some of those M&A firms that handle financial practice sales. And Mike, you're muted, but they also finance them too, I think.
That is correct. So one of the things that we look at is in that space. So we have a different group that does the wealth management advisors that will provide financing for similar M&A that we're talking about here in that space. They do spend time looking at the percentage of revenue per, the advisory side versus the life side. And they're looking for those that are predominantly advisors versus predominantly life folks. And a lot of it is for the exact reason that Michael just had mentioned, is that the business model or the revenue flows very front end heavy. So more interested in the advisory side than pure life. If an opportunity came to us from a pure life agent, we would not provide financing it in the insurance space, nor would the advisory side, again, for similar reasons. But it is a very active, investment advisory transactions, it's a very active market, and that group does quite well with the volume of lending they do in that area.
All right. Okay. So that was answered. I want to just pause real quick and read something that came in through the chat. You've probably all seen it, but this is a testament to our panelists who have come on today. So real quick, this person says, I have to leave soon for another meeting, but I wanted to let you all know that I watched another M&A session earlier this week, and it was a total waste of my time. I'm wishing I could stay longer, as this presentation is much, much better. So thank you all to our panelists. Hey, that's awesome. That is fantastic. We're
It'll be
doing good.
entertaining too. Not only we're informative, but we're entertaining, right?
Absolutely.
Good looking. I thought we'd go with good.
There we go.
You know, we're on camera, Mike, right? They can see us.
Yeah, yeah. This is a stunt double. This isn't really Mike Strackoff. So.
Just for everybody, so that you remember this, that we are on Spot On Insurance. If you search Spot On Insurance right behind us, and you go to the YouTube channel, you hit Spot On Insurance, you'll be able to find this webinar starting tomorrow. We have a boatload of webinars that we've done, but one of the things that we're known for is doing these webinars right, getting some really good points out there, and you guys have done wonderful in really presenting the knowledge in a good way. So it's been so informative for me. I've been like,
and I see Michael Trillion's message there. It just disappeared on my screen, but he said that he's a subscriber and that we give great value there. So thank you, Michael, for that. Yeah, and I mean, for anyone that does have to leave early, yeah, like Ted said, you'll be able to see the full webinar by tomorrow. So that's really helpful. The other thing is, guys, since we're on a pause right now, if Christian, if you could just take a moment to show where our podcast episodes reside. We have covered different episodes on M&A. And we have a whole host of compliance podcasts. We do so many things. We're putting together online courses. We do podcasts that come out every week, live webinars that started with COVID. And we have a tax calculator for the surplus lines industry. So we're doing a lot of things. But yeah, this is Spot On Insurance, on the website, and there's the host of, the array of episodes that we've done. And those are all on mergers and acquisitions over the last couple of years. So Russ, don't we stay pretty busy? We all stay busy.
We have another question that came in through the live. Actually, there's two now, but let me start with this. Which specialties or niches are selling for the highest multiples currently? Which specialties have struggled and which have prospered during the pandemic?
Very good question.
That is a good question. Which ones have, so we got multiple parts to that. Which ones have sold? Well, any specialty that's growing and profitable, I mean, that's going to drive a lot of value, a lot of interest from buyers. So, property rates are going up. I'm sitting in Florida, so property rates are going up pretty fast right now down here. So we had a client a couple of years ago that specialized in condo insurance, and his revenues are way up over the last few years. So, I don't think you can pinpoint any specific niche. If you're in a niche, you've got an expertise, you're growing the business, you're running it profitably, that's going to drive a lot of interest from buyers that are out there. And then it's a matter of what's your specialty, and then lining that up with the right strategic buyer that's already in that specialty.
All right. Another great question. As a startup P&C, what are the best practices to put the agency in the best position to be sold in 3 to 5 years?
Excellent.
Grow.
Grow and be profitable. Yeah.
So that actually leads up to one of the next questions that I had is, if you do plan to sell your business in 3 to 5 years, at what point should you put together your dream team of advisors? Those advisors that are going to tell you, hey, you need to be concentrating on this with your books. You need to be concentrating on this with your management team. Andrew, I'll start off with you with asking that question.
Sure. Usually, if you're looking to sell, it should be about a 3-year process. And I'm sure you guys have encountered this. One of the things that I've seen so much with a lot of the small companies that we've worked with is the financial controls, the record keeping. Definitely, to really have that solidified, outsourcing as much of that as possible and not handling it on your own. One of the things that we've also seen over the years is a company using the business as a tax shelter. And that can, create some problems when you're looking to sell. One, a lot of owners look to reduce income so that they could save on taxes. But, you have an issue when you're looking to sell because you want to make sure that you could get a high valuation as possible. So if you're doing those things, you really need to put in place that, okay, we're going to gear this business up to sell. We're going to forego any of the potential tax savings that we're going to get, and we're going to run it as if it were a viable business. So those are some of the things that we've looked at. Also, getting a lot of your corporate and legal documentation together, getting your operating agreements if you have partners. One of the companies that we bought, they had no operating agreement in place, and that can also create some challenges. So it's really about taking the 3 years to get your house in order legally, financially, and then also operationally.
Arlene, one of the things, I'll leave it to the lawyer to say this, but one of the things that's a good, something to plan ahead on is really estate planning as well. Some people don't think of that in the context of selling an agency or selling any sort of business. The reality is, and without getting into the weeds, if you sell your agency for a lot of money, and let's say you sold your agency for $50 million, the time to start planning isn't after the money has hit your bank account. There's planning that needs to be done well in advance. Candidly, some of the planning opportunities even fall away after a letter of intent to sell is signed. So really, it really makes sense to get far out ahead of that. Again, depending, if an agency is going to sell for a couple $1 million may not be as relevant, but if there's a lot of agencies going right now for very large dollars, multiples are strong as we've talked about. And for certain types of sellers, there's planning that can be done in terms of gifting and things like that, especially gifting during the COVID environment where, arguably, maybe multiples aren't even at their peak. There's certain things that can be done that people can save a ton of money by doing that planning well in advance.
Excellent.
Yeah, I would also
think, actually, Andrew raised a really good point. And, as a buy-side due diligence advisor, I think I've seen quite a few deals, whether it be through an auction process or proprietary deal, go on hold or potentially die when they near those really important negotiating points, just because of a lack of organization of documents. And simply put, I think it's key that, the company, as Andrew stated, prepare well in advance. And that goes across the board for a QOV, for insurance due diligence, health and benefits, legal and regulatory. It's important that they plan well ahead and they're prepared to release that information in time so that those potential bidders can perform the due diligence within a reasonable window of time.
It's interesting. This might be my perception, but at times, people come to us looking for financing to obviously finance a deal, and you get the impression that the deal was put together. Person woke up on Monday, wanted to sell on Tuesday, because if you look at it, it's just not an ideal situation to kind of move forward. And I put this in the context of a family or a perpetuation scenario where there's plans to transition the business to one or some of the folks that are already in the agency. These people then try and apply for financing, and they're not bankable. They might have bad credit history, they might have bankruptcies, but this seller has been relying on this plan for years to say, hey, this is what it's going to look like, or they can't come up with a down payment. There's other things that, had you assembled your dream team earlier on and understood what it might look like to get financing down the road for Junior and their friends to buy the agency, there's things you can put in place that can address down payment, maybe either gift or sell equity over time, so they're in a position of ownership at the time of the transition. can ease a down payment down the road. And depending on the size of the agency, some of these down payments can be large. So even reaching out to a borrower at some point and having a discussion to say, it's down the road, this is what we're thinking, here's the potential buyers, what should I be thinking about as I'm selecting or talking to folks in my office to buy me out? Because if financing is going to be required, there's going to be a few hurdles that everyone needs to be able to jump in order to make that happen.
Stephen, I have a question for you. Obviously, they need to assemble an M&A team. At what point in time do they want to include an attorney? Do they need to wait until after the letter of intent is signed? And in addition to that, will just any old attorney work, or should we go with somebody who specializes in M&A?
Joyce, that's a loaded question, and
It
I
is.
appreciate it very much. Thank you. Listen, I'm a big believer that, listen, if you're selling your company, it's the biggest asset, financial asset you have. You shouldn't take it lightly. So I'm of the opinion that certainly lawyers should be brought in relatively early in the process. Most good lawyers should, especially during sort of the when they're dating with clients, so to speak, are going to give away their time. So it's very easy, candidly, just to pick lawyers' brains off the clock. Oftentimes we will see a buyer who, a seller who does not have, they're not working with an investment banker like Michael, who's really skilled like Michael, or they're just trying to sell their agency on their own. And maybe, as we sort of alluded to before, there's certain things that are, structure may be more important than purchase price. Just getting the highest number on a piece of paper isn't the most relevant thing. There's other things that sellers need to understand about the process. We've talked about getting your house in order. They need to understand that. They need to understand, and again, certain investment bankers are going to do a better job than others. Michael's going to do a great job explaining to a seller about reps and warranties, indemnification, and all these things about how you can't really just, sell your agency, hand someone the keys and take the money and you don't have any worries. And so there's things that need to be done there, so sellers are better prepared to understand the transaction. There's things that need, as I said, there's things that need to be done in advance as it relates to estate planning. Oftentimes we get involved, we think there's things that need to be done with key employees, making sure that key employees are buttoned up, whether through restrictive covenants, whether through bonus programs. You just don't want your producers walking out the door with their books of business. So there's a lot of stuff that can be done there. The unfortunate reality is we've seen sellers who are selling for $20 million, $30 million, $50 million, who they're sort of penny wise, pound foolish, or whatever the expression is. They don't want to spend the little time and money trying to get their house in order. They don't want to spend the money, literally an hour with the letter of intent with some of the standard buyers in the space. It doesn't take that much to really add some value. But unfortunately, sellers are selling for these big dollars and will literally not bring in advisors. They will choose the lowest cost service providers. And it's, I don't know, it's just sort of a shame, but we like to be brought in. We like to be brought in early. There was sort of a part two to that question, and I think I skipped that.
One of the things was, should it be done before that letter of intent?
I believe the letter of intent is certainly the panel is aware, most of a letter of intent is actually non-binding. There's only a handful of binding provisions in the letter of intent, mostly the exclusivity provision. That's sort of the key binding provision that says seller for X number of days, usually about 60, 90 days, you can't talk to any other buyers. So in some respects, a buyer's objective under the terms of a letter of intent is to put a purchase price out there, and because they haven't really done significant due diligence and they just want to get a seller under exclusivity. And then at that point, they'll do more due diligence and really start the process. That may be sufficient for some sellers as well if they're confident with the buyer. But if it's important to a seller to understand some of the other details, it's worthwhile to get into the weeds a little bit in terms of what an offer is. Again, $20 million from buyer A may be different than $20 million from buyer B. Buyer A may have reps and warranties that survive closing for 60 months. Buyer B may have reps and warranties that survive closing for 24 months. So there's kind of the devil's in the details. And for certain sellers, if they want to get into some of those weeds, it's important to bring a lawyer in to at least explain to them what's in there, what could be in there. Doesn't mean we always negotiate everything in a letter of intent, but I think a seller should be educated before they sign that letter of intent. Because even though it's, as I said, most of it's non-binding, there is an element of good faith, and to retrade on points, although it probably happens in every deal, you don't suddenly want to start retrading on every point.
Yeah, and just to add onto that, which very good point, Steve. One of the things, if you're not educated in this space, right, which most insurance agency owners are not, or, and I keep saying insurance agencies, it could be a service provider, right? One of the things that they have to recognize is a lot of times there's a holdback. Like, you go into a transaction and now all of a sudden they want you to put 10% or 15% into escrow. And I know, Corey, those are some of the things that there are insurance solutions for that. So if you could just touch upon that a little bit, on explain a little bit more on what I'm talking about, that, a lot of times on a deal, they might say, you're not getting all your money right now, and this is why, and there's some of the solutions that are in place for that.
Well, in terms of the escrow, it's more specifically about the rep and warranties, the transaction. There are tax indemnity solutions that are available. However, what we found, it really depending on the deal size, and I'm sure Steve has seen quite a few of these policies in the past, but this particular product has evolved so much over the last 20, 25 years that it's almost on every single deal that I work on, with a few exceptions. However, ultimately, the best way for, there are buy side and sell side rep policies. Oftentimes I'm involved on the buy side. So, the buyers are trying to mitigate, fraudulent or wrongful statements within the purchase agreement through the purchase of a rep and warranty policy, which provides them with coverage for a period of 6 years. But, by purchasing that policy, it puts them in a very, very good position in regards to, for example, an auction process. And it can also be useful in a proprietary deal as well, if they're under LOI at that point. But ultimately, it's about mitigating the financial loss associated with wrongful statements or representations within the purchase agreement. And I'm only an expert that's dangerous enough to discuss it at a high level. Folks that are more well-versed, such as Steve, we have M&A lawyers that really get into the weeds and try to sort of negotiate those policies for the benefit of the buyer, or instances where the seller's involved and they're seeking the policy, so that, the carrier who potentially underwrite that policy will have the most favorable terms for the party that they're underwriting it for. But it's all about the mitigation of risk, at the end of the day. Tax indemnity is another area that, that requires a lot more knowledge than I have right now to speak about. But it's a great tool to use if there are tax issues that need to be addressed.
Corey, you referenced rep and warranty insurance. A couple anecdotes for purposes of for potential sellers out there. Usually we don't start seeing rep and warranty insurance, just given some pricing, until a deal is probably over $30 million, but often $50 million. Corey can speak better to it than I can. I would also just say anecdotally, I've done several hundred deals in the industry. Often some small ones. We've got a couple deals right now that are over $100 million. And what's if we were selling a manufacturing firm for $100 million and private equity was bidding on it, rep and warranty insurance would be referenced in the LOI as a way to sweeten the deal from the buyer's perspective. What's interesting is in the competitive, world of agency sales, buyers in these larger deals are not leading with rep and warranty insurance. So it's just sort of funny that the big brokerages are not really using RWI. So just a sort of an interesting anecdote. Corey, I don't know if you have a reaction to that at all, but we have to really sort of beg and plead for it in those deals. So
no, absolutely. No, that's a very good point. The product itself is very, very cost prohibitive in terms of those smaller transactions. So ultimately, it's more useful in, in auction processes with private equity firms. That is where you'll see it most. But as Steve stated, it's a product where the big brokers aren't really utilizing. I feel like they're just fairly comfortable with their balance sheet position, and they feel like they can move forward really aggressively just through their expertise and understanding of these potential insurance agency targets or similar.
Sellers should be asking for it more. Seller deals where there's a lot of shareholders. We're seeing a lot of ESOPs in the insurance space that are selling right now. Rep and warranty insurance is a very valuable tool when you've got an ESOP that is a part owner of an agency. Joyce, I think this sort of goes to your part two of your question. Do you need a specialist from an M&A perspective, an M&A lawyer who focuses on whether it's just on M&A or insurance? And it probably is the same for all of us. Certainly, from an investment banking standpoint, you probably could hire someone who is just a generalist, investment banker. But Michael knows every single buyer in the space, knows all of the, knows everything about the industry. You want to be working with someone like Michael who really understands the process. I would say in our world, and Dave probably can speak to this a little bit when I'm on the buyer's side, the worst thing in the world, not the worst thing, but the worst thing as part of the deal is when a seller will bring, with all due respect, a divorce lawyer, a PI lawyer to the table. Those guys do things I don't really, I can't do what they do, but they really, it's somewhat malpractice in my eyes for a divorce lawyer to try and sell an insurance agency. There's nuance, there's industry vernacular. They're just not well suited. When buyers are educating sellers' lawyers about what disclosure schedules are, what reps and warranties are, seller, you should understand you've got the wrong lawyer at that point. We actually get a lot of referrals from big buyers in the space who rather work with a sophisticated law firm that may, that's not going to sort of bend over backwards on every buyer request. And we're going to push them a little bit, but they rather work with us because we understand the process. The difference between a general M&A attorney on these deals and an M&A attorney that understands this space, I also think is pretty significant. A general M&A attorney, if I was selling a manufacturing firm to Andrew private equity and having nothing to do with an insurance deal, Andrew and I are, our clients are going to go 25 rounds. They're going to beat each other up. It's going to be bloody. Okay. That's how a lot of deals would work. And if you hire a lawyer from a lot of firms that just focus on general M&A, their training is to be the smartest person in the room, to beat up the buyer and fight over every single point. In the insurance world, it doesn't really work like that. Michael's done a gazillion of these deals, and he knows sellers, attorneys who are experienced in the space, they know that the buyers are programmatic in the approach. So we have to tell our sellers, hey, seller, sorry, you're selling for $30 million, but you're not going to get a custom deal from one of these buyers. You're special, but you're not that special. We say it a little bit nicer than that. But, some of these big buyers are doing 5 to 10 deals a month, and you got to keep on track. You got to, so you want to stay in the queue, especially this year. You want to close in 2020. I'm not saying a seller's got to take all the buyer's positions and not negotiate a deal, but you can't monkey around because a buyer is just going to kick you to the end of the queue, and suddenly your deal goes from an 11-1 to a 12-1. And if something bad happens, suddenly you're closing in 2021. So a good seller's lawyer in this space understands the difference between agency bill and direct bill, understands how the buyers operate, understands you can't live in a world of massive red lines and fights back and forth. There's just no time for it. These deals also tend to be friendlier. Buyers are doing a lot of deals, okay? So most of the buyers are pretty centrist in their approach. They don't have time. Dave is doing a lot of deals. Dave doesn't have time to go 25 rounds with every seller. So, you know, there's sort of, you have to take a reasonable approach in doing these deals. And again, a lot of just sort of general M&A attorneys, they don't understand just sort of how it works. It's not magic, certainly not rocket science, but there is a little bit of industry experience that I think goes a long way.
Excellent.
Yeah, that was spot on.
No
We
pun
have
intended.
Oh, that was good. I like what you did.
I would add one thing on that, not to give like a commercial for Mike's firm, but as a buyer, there's value.
Don't worry about it.
That's Michael. You're giving an advertisement for me, right?
Mike, both of them are great, wonderful. But there's value in a prepared seller. To get to what Stephen was talking about, not only the whole penny wise pound foolish as a seller, there is value that you'll get as a seller. But I would argue that in many cases, their expertise, whether it's your attorney, your whatever your team is that you're putting together, that you'll get that value back in spades. But then also, to Stephen's point, when you have a prepared seller, when you are trying to do things and accomplish things, you can actually get them done because they've been prepared by professionals. So it's not, don't fear, if you're an agency looking to sell, don't fear bringing in those advisors for what is a very important transaction, because I would argue whatever you pay for them, you'll get back in actual real dollars and cents value for your agency, but also time and energy. And you may get even more in your acquisition price because you're prepared and your expectations have been set clearly. And that is attractive to buyers that are constantly trying to analyze different situations. So it's worth it in any way that could possibly be meant. It's worth it to bring in those professionals and work with them right out of the gate, in my opinion.
And really, the sooner the better, right? Michael, you and I spoke earlier in the week, and I know I'm skipping ahead a little bit because this is something that I wanted to ask, but if I'm not mistaken, I think you said ideally they need to be in contact with someone like you at least 2 years before they intend to sell.
Yeah, and Andrew talked about this a little bit, maybe 20 minutes ago.
Mm-hmm.
I mean, ideally, probably we want to, 5 years is in some cases necessary because, again, we talked about C corporations, but, it takes, correct me if I'm wrong, Steve, but it takes 5 years to convert from a C corp to an S corp. And the reason why you might want to do that is because when you sell a business owned by a C corp, most likely you're going to pay double tax on the sale. So it's going to greatly decrease unless you can come up with a creative solution, which is such as a stock purchase and things like that. But that limits the number of buyers that would be interested in the deal. So, I mean, in some cases, 5 years, I think at the very least 3 years. I mean, we've got a client we're working with right now that we've been working with him for 7 years. We're about to close the deal in the next couple of weeks here. But we would update the valuation maybe every 2 years. And during that 7 years, he's more than doubled the value of the business and finally exiting. But there are things you can do. I mean, again, Andrew went through this, clean up your financials. You're going to have to share your financials with other parties. It's going to be a buyer. It's going to be whoever's financing it, if it's a lender or private equity. And so there are things you need to do to clean things up, get your house in order. So I'd say at least 3 years. That was a long answer to say 3.
No, that's good. We have another question that came in through the Q&A. Would you encourage companies to engage in M&A deals during an economic downturn?
I think that was a general question. So that might be a good one for Andrew too. Not just the insurance.
Maybe so.
Yeah, I definitely, it depends, right? What side of the table that you're at. And one of the things that I wanted to say even before, we are living in unprecedented times. I think we're not going to know the results of COVID because this is a worldwide phenomena, and I think it poses opportunities and a lot of threats. And I think you just have to be wise on which path that you choose. I think as a buyer, and that's mainly where I'm focused now, is I believe that there are opportunities out there to really get undervalued assets. And for instance, I'm working on advising a company right now, and because of COVID, they had a solid year. This was probably going to be one of their best years, and because of COVID, they do in-person training. And because of COVID, revenue went away all at once. And so that put the seller, and we were negotiating this deal prior to COVID. And COVID put them in a position where they were so much more amenable to a sale and to the terms that we were looking for. And so that really helped my client, that, you know, you've got a motivated seller. So I think that there are definitely those opportunities there. And also if you're looking to sell, there's also going to be uncertainty in the economy going forward. And this might be a good time to really look at selling, because I think we have never experienced a worldwide phenomenon like this. You know, what's the normal going to be after this? And so if there's an opportunity to sell now when there's an uncertainty, I think it may also be a good thing to do.
Yeah, the question we've been saying is, are your financials going to look good 12 months from now, or, you know, the last 12 months? And that's a question a lot of business owners need to ask. You know, because the purchase price is based on the 12 months leading up to the sale. So is it going to be better for you looking at back now, or waiting 12 months or 24 months? And, you know, regardless of industry, that's a question a lot of people have to ask.
Let's talk about accessing capital. Mike, if you could tell us, if you are an acquirer that needs financing, how should you go about preparing to access capital? And then what do you want to look for in a capital partner?
Got it. So some of the items were touched on already. So if you're in a position where you're going to, you want to be acquiring or continue to acquire, I mean, a lot of what we talked about is making sure you have your corporate docs in place. You got your, your house in order from a profitability perspective. Those things are kind of table stakes. And from a lender is going to look at the cash flow. I mean, you're going to, as a lender, depend on that cash flow in order to determine whether someone's going to be able to pay back the loan or not. So when we do see financials that are showing, unprofitability over an extended period of time, it certainly brings into the question, how are they going to afford this debt? And I understand there's a lot of reasons for people to construct their financials in a way that allows them to do different things. But you can't have it both ways. You can't, not make money and expect someone to lend you money. And someone said it earlier, run your business like a business, or run your business like you're going to sell it tomorrow, and you become a lot more attractive for a lender, certainly to talk to. The one thing I would highly recommend, and again, whether it's, in the near term or midterm interest in acquiring, is talk to a few lenders and say, what is it that you're going to need from me? What do I need to look like? What's the criteria in order to obtain financing? So you can start to develop, a profile, the profile that they're looking for your agency. And, when we start talking about preparation, you can't do that overnight. That might take, in some cases, 2 to 3 years to have a strong history. It might take some subtle tweaks to kind of get you in line with what a borrower is looking. But it's better than fumbling around in the dark, finding a good target, and then go looking for financing is definitely the strategy I would stay away from. As you're looking for a capital partner, I'd highly suggest working with a bank or a lender that understands the industry. There's a lot of folks out there. Steve, some of your comments earlier with regard to working with an attorney that is familiar with the space. I think a lot of those statements apply equally to a lender. Because there's a lot of folks that are looking to lend money, but have a tough time getting their arms around the intangible asset of an insurance agency. At the end of the day, most bankers are looking for something that they can touch, the building, the equipment, the inventory. What are they going to sell to pay back that loan in order to recoup their dollars and either lessen or eliminate a financial loss? Meanwhile, we're having an M&A webinar right now where we're all talking about what great space this is, that there's a market for agencies in the event that there's a problem. So in the event of default, I think a banker understands that there is a market for, a situation where you have a piece of financing out on an agency that does default or has financial problems.
Mike,
So,
have you ever had an agency default?
it's a great question. So we've been doing this for 5 years. We have 0 defaults.
Exactly.
We've had maybe one deal, which we're going to consider on watch list, which is personal watch list, that there's some indication in the financials that we're watching closely, and that's a portfolio over, we'll say a few hundred loans. Since COVID started, we now reach out to our customers once a month and have a conversation with them, and we collect their financials quarterly. And we are seeing consistent performance. Some of the comments that were made here is who knows what the future holds. And, if you're a heavy commercial agency, you got to be concerned about future audits or, cancellations that could impact revenue. And all those, concerns are certainly real. But I would say that most agents are still pretty bullish on the business. We in turn are bullish on the business. And having a bank that understands that when you're talking to an agency can be the difference in, obviously a ongoing working relationship, but can really save you some time than doing a dance with a banker for a month, 2 months, maybe even longer, and then find out at the end of the day, hey, this is an intangible asset. The bank's not comfortable lending on that, and they're kind of starting from scratch on day 61 or day 63. Where they could have been talking to a bank that understands, or a lender that understands the business right out of the gate. So a few thoughts there.
Very good. One thing that I want to pivot right now and go away from financials. And
could I throw one thing before we pivot off this topic?
Yeah. And then the question is going to start off with you, since you're doing that.
Okay, all right, yeah. So accessing capital, that's one of the main differences, I would say, with us in our space. We're not private equity. We're not PE backed, nothing like that. We started literally in my basement 12 years ago now. So accessing capital was always a massive part of the conversation and question. So if you're looking to acquire an agency, I think the thing that really grounds it for people, like going to buy an agency, not many people have done that, but a lot of people bought a home. So it's kind of like when you go to buy a home, you get pre-approved. And that's what Mike's talking about, to talk to people and kind of say, where do I need to be at? Look at where I'm at now. What are the parameters? Give me a box that I need to hit. Give me something like that. And it's kind of like, loading the gun before going hunting. You know what I mean? Like, you don't want to just get out there, find something, and then scramble, especially because there's probably other buyers on that if they hear being for sale. So that's like my number one thing, is get pre-approved, if you will. 2, talking to the right banker. I can't tell you how many wasted conversations and cups of coffee and all these things about it. The banker, they either get it or they don't. There is no let me see here. I even had one guy who I went to college with, played soccer with, and he was a senior VP at the bank. They didn't get it. Even with the best relationship in the world, that wasn't going to happen. So the right banker is huge. And literally, it's a black and white situation. Do you like lending to insurance agencies or not? If it's yes, they get it, moving on. If it's no, you got to move on. The third thing I think too, that's not always, I would be curious to the panel's views on this, but seller financing. We've been shocked at how many sellers are interested in what I'll call annuitizing a portion of this payout. Again, one question that they're asking themselves is, what am I going to do with this money? You know, that's a big part of, do I even want to sell or not? What am I going to do with it? And so sometimes I'll kind of say, hey, I'll leave a little bit, we'll do this part because I do understand the business. I'll leave a small portion in and you guys can pay me that out over time. So that's part of it. And then I think there's private options too. To be totally honest with you guys, there's not a lot of people that I know in my world who'll scratch a check for $1 million, but we were able to put together a group of 20 people who were all $50,000 realities. And literally because I'm telling you, this was bootstrap stuff, but like we weren't able to, I know there's professional ways to make sure that they save the money for you so that it's there available, you know, when you need it and that kind of thing. But these were just handshake agreements with people that said, if we can find the right opportunity, will you be somebody to come in? And we were able to pre-negotiate our interest rates, our terms, all these things. And then again, it was almost like that private pre-approval. So that way, when the opportunity was there, we had already done the homework. If you find the opportunity without the homework, you'll be cooked pretty quickly, I would argue. But so yeah.
Very
Your comments on seller note, though, it is still very, very popular. At times, I feel like our biggest competition, because there is an aspect and there is that, you know, need by some sellers to kind of annuitize. You're exactly right on what's going on. The one observation I would have is that at times, with sellers holding on to their agencies longer, you know, to have a 5-year seller note, you know, could be at the detriment of the elderly, you know, seller. That could put pressure on the deal, on the cash flow. So, you know, we'll come in with a 10-year term note. It spreads the payments over a longer period of time. It's friendlier to the cash flow. But you have a seller that wants a 5-year seller note. You're going to compress the timeline for that portion of the seller, you know, for the buyer to pay that back. It can have ramifications. So we try to get a better understanding early of what the structure is, and if there is going to be a seller note, what's it look like? Because we obviously have to analyze that from a cash flow perspective.
Very
Yeah,
good.
you don't want to take a deal to the bank after you've already negotiated and then have it restructured. That's why it's good to talk to you up front.
Yeah, absolutely. Gets a little messy.
Yeah.
Very good points. So Dave, this question is for you. And I know that there's so many differing opinions on this, but at what point, you know, sellers ask this all the time, at what point should they let their employees know that they're thinking about selling the business?
And you're on mute.
Yeah. Man, that is a great question. And I'll say what seems to happen and what I think is best. What I usually see happen is the deal, let's say, closes on Friday, and on Monday morning, everybody found out they've been sold. And I think I understand parts of why that is. The amount, especially in the insurance business, we are in a service and trust-based business. So if you were to say that and spook a member of the team who's critical and they go, that's going to potentially kill your transaction. So I think self-preservation is usually the reason. I think a lot of sellers that we deal with have high respect for their team and wish they could have told them 6 months ago or whatever. But what we've seen work very smoothly, and I will say this takes a lot of trust. We were shocked the first time it happened because it takes a lot of trust by the seller, is once everything was in writing in black and white, you know, escrow money was in, all those things that we were introduced prior to the transaction happening. Because I found that for the teams that remain, their number one question is, do I still have a job? Which I totally understand that. And so we were able to come in together. We now have an onboarding process where it says it's us and the current ownership, and it's how did we get here today? Giving them that background. Hey, we've known Steve or Brenda, I'm just thinking through some things recently, Steve or Brenda for 12, 15 years. And we've gotten a chance to see what their culture is like, hear about you guys as a team. And that's why we did this deal, not because the EBITDA was off the charts excellent. Like if you know, I'm sure everybody knows not to go there, but like that was probably the best and smoothest acquisition we've ever had, to where it felt, I think, like it felt to them as a merger and that they were a part of it, and that owner chose us because of what we said we would be doing for that team. And there was a trust factor there. So as to when to bring them in, as early as is realistically possible. So my answer to that in one sentence would be the day after the deal is inked, before transaction complete. That would be my thoughts.
Arlene,
Yeah.
most of the buyers that we're dealing with in the space are requiring notification to the employees a little bit earlier. Employees are already uneasy in the COVID environment. So the sense is you got to kind of keep the employee, you know, this is people business. So you got to keep the people in the loop a little bit earlier. Onboarding remotely is also presents a lot of challenges. So the big buyers are certainly doing Zoom meetings, and employees are very concerned during this time about employee benefits and making sure there's no gaps, 401k and all that sort of stuff. So they really are, while they can accomplish some of that over Zoom, papers need to be signed, and things like that need to take place. So we're definitely seeing the process push forward a little bit. I would add, if I was a seller, one of the mistakes I think is not at least letting someone in your agency know. Michael, I think we've probably talked about this at some point. Selling your business, whatever kind of business you have, but focused here on insurance, is a ton of work. The buyer, Dave may be the exception because he's a really nice guy, but most of the buyers are going to ask you a gazillion questions, and you will have due diligence go on for a long time. And when you think due diligence is done, you're going to get another 30-page due diligence request. It takes a lot of time. If you normally work 8 in the morning till 5 at night, just on your day job, when you go to sell your business, suddenly your days are going to start at 6 in the morning and they're going to go to midnight. To do all of that work yourself is really, it's exhausting. Now, if someone was going to pay me $10 million, you do it. I mean, that's just, that's the price for admission. You run through a brick wall. That's what you do. But I do think it's important to have some consigliere, if that's the right term, on your team who is in the loop that you can rely on to help you throughout this process. What does that mean? That means sellers probably should share in the proceeds a little bit. Sellers should reward their key employees through some sort of retention bonuses. Certainly, most of the buyers are requiring earnouts, and the fact that you are sharing a little bit of the sales proceeds and potentially some of the earnout with your employees, it's a little bit of a carrot. It's certainly money out of the seller's pocket, but it will help you get to a closing and will help you hit the earnout, and it will be looked upon very, very favorably by the buyers. Michael, I don't know if you want to react to that, sort of the buyer's reaction to a seller who will not share at all versus a seller who is going to share.
Yeah, I think that for a lot of our clients, they don't even know how to run reports, right, from the management system. They rely on somebody else to do that. And so for a lot of them, it's a great relief when they get to the point where they can tell somebody what's going on. And it's usually in an office administrator. But, definitely you don't want to tell all the staff. It just causes stress on staff. You try to postpone it until you know it's pretty much a done deal. But there are key employees that typically have to be disclosed on the transaction, probably right around when you start due diligence, because like Stephen said, there's a lot of work that goes into that. And the best way to get them engaged in that and get them excited about the deal is to reward them on it. And the most success we see is when our clients share some of the proceeds with key employees. They get them involved in, into the transaction process a little bit earlier. And it's more successful. It's much less stressful for our client if they've got somebody in their office that they can rely on to help, get the documents together for due diligence and talk about what's actually happening. So, yeah, I would say that's the best way. Find a key employee or 2 key employees, engage them early, get their buy-in by sharing some of the proceeds with them. But for the rest of the staff, it doesn't really do you any good to tell them until it's a done deal. And that could be the week before it closes if the documents are pretty much signed and you're just waiting to close. But that's my recommendation is, get a key employee plugged in, reward them for helping you through the transaction.
Can I ask you a
The
question?
related point is taking care. Sorry, Mike, if I cut you off, go ahead.
No, fair enough. I was just going to ask a question, probably for Michael, David, and Stephen. By way of, you have producers, or you might even be looking for non-solicitation for other employees. What's the timing of that? Is that pre-close, post-close, and how do you ensure the best outcome?
Most of the buyers are going to require staff to sign some sort of restrictive covenant agreement at closing. Mm-hmm. Certainly the producers are that's the biggest issue. Mm-hmm. The key producers absolutely will have to be signed, sealed, and delivered at closing. Really, no exception, as far as I'm just based on my experience. Sure. Like you were going, that was sort of where I was headed. What I was going to say with the producers were, one of the things I don't think we've mentioned in our 90 minutes or however long we've been on this webinar so far. Oftentimes we find producers that have an interest in their book of business, a contractual right. And that is a major issue to deal with, both in terms of getting signatures on documents, dealing with in advance. Oftentimes that's, there's multiple ways to structure that, but there is, sometimes those key producers may be going from commission rates of 45-25 with a seller down to 30-20, whatever it is. I mean, there's big changes potentially for these producers. So to go to your producers on Thursday and say we're selling on Monday it's just not going to happen.
Oh, I heard of a deal that blew up because of that. Yeah, you're dead on that. I heard of a deal not too long ago that blew up because the owner waited till the last minute to tell the key producer, and the producer said, "No thanks, I'm not interested." But what's worse than that situation is not having an agreement with a producer. And we run into that sometimes where there's not even an agreement. They have an agreement on compensation split, but there's no non-solicit. So yeah, producers are also key parties that have to be generally brought in, at some point during the transaction.
Very good. Excellent. And Steve, you mentioned earnouts. So let's jump right into earnouts. I want you, just talk to us about the pros and cons that a seller should be aware of.
Sorry. The pros and cons, there tend to be a lot of cons. Michael could probably, or Dave can articulate it better than I can, but I sort of put earnouts in two forms of buckets. One bucket would be an earnout based on retention. So retention of accounts. So if your agency is valued at X, most of the buyers, the big buyers, are going to pay you 70 or 80% of X, just roughly. Michael can articulate better than I can. And you have the opportunity to earn the balance of that valuation based on retention of existing business. And then, so that may be a maintenance earnout. There's a lot of different terminology that floats around. Then there's going to be earnouts that are based on growth. Really stating the obvious, the growth of the business, generating new business on a go-forward basis. The earnouts are, well, I would say in this industry, earnouts are a little bit more standardized, so a little bit easier to negotiate. In sort of non-insurance M&A deals, the earnout is where there is just massive amounts of time spent. If you look at litigation, M&A litigation, most of it relates to earnouts or restrictive covenant disputes. In the insurance world, though, the reality is a lot of the buyers have a way of doing their earnouts. And while Michael, representing seller, can maybe massage certain things, there will be a sort of a predetermined path to get to the earnout. There will be some predetermined mechanics. So it's a little bit less negotiated, I would say, in this space. Sellers should know that earnouts are unsecured. So when you are selling to big private equity backed buyer, you are not in theory, the documents will say that if, you stand behind the bank, if there is a default, most sellers are going to be asked or will be asked to sign some sort of subordination agreement, perhaps. I've never seen any earnout ever delayed by some of the big buyers in light of the subordination issue, but that's something that sellers have to understand. Sellers also have to understand when we're selling a manufacturing firm, there will be a lot of language, a lot of time will be spent saying how the operation is going to be run between closing and earnout for purposes of, maximizing the earnout. The buyer can't make certain decisions. Really, there's a lot of tight controls that the seller will want to have over the process, will want to have over the business to make sure that earnout is secured. I think in the insurance space, for most agency sellers, the reality is the buyers will throw them a bone and they'll say, hey, seller, we own the assets. It's our company at this point. We are, but they'll throw you a bone. They'll say, we're not going to do anything to intentionally take away your earnout. That's probably the best you're going to get with most of the buyers in the space. I will say, I tell sellers all the time, even though all of that looks pretty pro-buyer, I do believe, well, one, we've done hundreds and hundreds of deals. We've not seen disputes over this sort of stuff. Buyers are paying tremendous amounts for these agencies. Michael can talk about it better than I can. And I firmly believe that a buyer wins when a buyer is paying the earnout. That means it's a good deal. So I do think interests are aligned. I also think this industry is somewhat self-policing. Michael's got a list of 25 or 30 private equity-backed buyers, the 3, 4, 5, however many number of public buyers, and then a whole other stream of buyers, the sort of second-tier buyers out there. If there were, as a big buyer out there that was taking specific action on a regular basis to really reduce the I'm trying to say it without some bad words, to really reduce the opportunities for the sellers to that buyer, Michael would just take that buyer off the list. There's plenty of other buyers out there. We are not, it's not needle in the haystack to try and find a buyer of an insurance agency. So again, some sellers will firmly believe in that. Some you have to convince a little bit more. But there's a little bit of leap of faith, but we've never had a deal, knock on wood, we've not had a deal get stalled by any of those sorts of mechanics.
Yeah, it's not in their interest to be a bad actor in the industry because everybody talks to each other.
Very good.
We're getting short on time.
I have a question.
I guess to your point, let me just finish a point on the earnout. Almost no deals is someone going to be paid 100 cents on, is someone going to be paid without an earnout. There's almost always going to be an element of an earnout. So sellers really, really should expect that. We have one deal going right now where it's partially owned by an ESOP and there's close to 100 other shareholders. That's almost a unicorn agency that I've seen. It's just a really weird set of facts. And because of that, an earnout gets really, really messy. In that deal, the buyer is structured sort of a special, it's not purchase price, but there's sort of a special incentive for the management team who's going to stick around to achieve some hurdles. But all of those hurdles would really be income to the management team on a post-closing basis. But in that deal, where I said before, 70, if you're valued at 100%, you only get paid 70 or 80 at closing. That's the one deal I've seen out of a couple hundred deals where truly the seller is being paid 100% at closing.
Okay.
If I could jump in real quick on that. So, we are talking about two different types of buyers, and we should be clear about that. There's the large national buyers, the private equity, the public brokers. All of their deals include earnouts. The private buyers, like Dave or the ones that Mike probably works with, very few of those deals have a traditional earnout in them. And the main reason is just it doesn't cash flow well. If if you can go borrow money, pay it back on a 10-year term, why would you want an earnout stuck in there that you've got to pay a lump sum after 1, 2, 3 years? You can get a little creative with some of the financing, but it's less common in we'll call it the smaller world of deals. But if you're selling to one of the national top brokers, it's almost always in the deal.
Yeah, I would concur, Mike. And really what we'll see in lieu of a traditional earnout might be a seller note with an adjustable payment in the event that certain events happen. So it acts as an earnout, but there's an agreed upon price that will actually reduce the seller note by whatever the performance is over time.
So for the smaller transactions, and Dave, this question is going to be for you. How should an agency owner go about to have confidence in the buyer's financial strength? Maybe the buyer's asking, the prospective buyer's asking for exclusivity, and how, should they gain that confidence?
I think the main thing that comes to mind are just one is not being afraid to ask. You do remember the position that you're in that transaction. You have something that a lot of people do want. And I think that's important. Obviously you found somebody that you feel you mesh with in one way or another, but there's nothing wrong with asking, hey, I need to see that if I say yes to this, you can complete this transaction. So that's the first thing. And the second thing is, we talked about it, not being afraid to bring in experts. And that may be something that's beyond your accountant that's done your books for the past 25 years. You may want to talk to somebody with a little more experience on that space. So that to me is really everything, is not being afraid to ask and not being afraid to ask your buyer or for help on the other side once you have the documentation and just going through it from there.
It's a little difficult if you're a seller dealing with a buyer directly, because it's either a situation where you're trying to solicit discreetly, solicit interest from parties, in which case, how do you get them to sign an NDA and all that stuff before you even tell them who you are? But if it's somebody then there is a little bit of a psychological hurdle to just come out and ask them for it. We always ask for financials on anybody, unless we know they're a large national broker. We always get financial information on them, but it is difficult if you're dealing with a friend that owns an agency and you're talking to them about buying you or something like that. There is a hesitation, I think, to ask for it. But Dave's right. You gotta just ask for it, and you've got to treat them, as if they're any other party, and make a decision whether or not you think they're capable.
Very good. And so I want to just pause for a minute, because I told you guys that this webinar is being live streamed on different platforms. And one of our viewers on LinkedIn is Ngazi Naji. So I want to say thank you, Ngazi, for watching this on LinkedIn. And she also has a question for us that I'm going to go ahead and share with the entire panel. So she says, historically, Black agency owners have had a hard time finding buyers, especially those that look like them. What are the stats related to M&A for Black-owned agencies? And again, I'm going to throw out, it's not just Black-owned agencies, but maybe Black-owned service providers. So if you guys have some stats on that, I don't know who wants to tackle that.
I have a thought on it. Going back to what we've talked about, how you add value, and this for me gets into this is deep water, honestly, if we're being honest. First of all, if you as an agency owner, one of the beauties is that you do get to pick your buyer. You know what I mean? So that's a wonderful thing. And so if that's something that you're passionate about, I have no idea about the stats of the transaction or the ability to find that particular buyer. But I do know that, so you said this question asker was also female?
She is female, yes.
I think this is a major problem for our industry, or just a thing that our industry needs to get better at, is not only for an owner of color, but then also as a female. When I'm in rooms, honestly, I don't see it as a ton of either side of that equation. And so it's something we're passionate about. So maybe this is the wrong answer, but I know it's something we're very interested in as buyers. I also think a part of this conversation is we're not trying to force anything. If we find somebody who we really trust and respect and they're running a great agency, I'd be extra excited, if you will. You know what I mean? Just speaking frankly, I know these are things. So, but I have no idea as to the numbers, but I would encourage her that the right transaction partner should see a ton of value in what she and her firm brings to the table. So,
and I'll just say out here, as a minority-owned business, you know, we're a service provider to the insurance industry. I have to say, in our case, we have been approached by 3 in the past, multi-billion-dollar big players in the industry to acquire us. So there's hope, you know, like there's like, if you provide a great service and your value can be, you know, looked at, it's there, you know, and at least we felt that, you know, from our perspective, and we're totally open with our team. So it's not like, you know, we hide these things. In our case, we have had all these conversations with our team.
Andrew?
Absolutely. I mean, I think that this is a godsend that I'm on this call. You know, I have not been connected to the insurance industry, but my job as an entrepreneur is always looking for value. And, you know, I've got connection with the finance community. And so maybe this is something that we need to do, is to really look at creating those opportunities for exits. And, you know, so that's something that I'm going to go back to my team and look at in terms of pursuing. So
Very good.
Good.
And the other thing is, we were asked by lots of the attendees to please post all of our panelists' contact information. So we will be doing that. We do have everyone's information from when they registered. And correct me if I'm wrong, Christian, but we are able to send emails to all of the participants so that they can have the contact information for all of our panelists. Additionally, if you are going to miss any of these webinars, if you come up with a question that you think of over the weekend or whatever, you can send those questions to ccquestions@ilsainc.com. We are at the 2-hour mark. Man,
Guys.
this has been like, we didn't even get to all of the questions. And that's why
Riveting.
we have a 3-part.
That would have to be the
You
word,
guys
riveting.
were awesome. Thank you for all of the information that you guys shared today. I know you guys provided so much value to our audience, and we can't wait to do part 2 in the week after next.
Awesome.
We didn't even get to everything today, but that's okay. Leave some for next time.
Happens to
And
us all the
Mr.
time.
says thanks for the information, and look on that.
And then if you're wanting to know what we're going to do in part 2, we are going to talk about deal challenges. We're going to get more into the transactions, rough patches, negotiation failures, some solutions, lessons learned. This is where we get these guys to tell us the horror stories, like how it went so terribly wrong. Give us the analogies. And we lost Corey a little bit earlier. He had to go. We want to hear about the different types of buyers. We're going to listen to Andrew talk to you about premium for synergies. There's so much more to come, and that will be in part 2.
And Matt Schneider is going to be joining us,
Yes.
talking to us a lot about the insurance solutions for a lot of the you know, what can go wrong in the deals and some of the insurance solutions there. So we're looking forward to it. Thank you guys.
Outstanding,
so much.
guys. Outstanding.
Thank you, panelists.
Thank you.
thank you guys. See you later.